In a move that defies belief, Tesla investors have placed $1.2 billion in the Tesla Max Yield ETF, TSLY. I did a video on this in August of 2023. I talked about how TSLY destroys shares, and they continue to destroy shares in 2023 and have destroyed further shares in 2024. I'll show you the math behind that and talk about why. This is my opinion. Do your own research, not financial advice. Trade at your own risk for entertainment purposes only. And what I did in August of 2023 is I looked at 10 years of Tesla data. And what I found was that if you practice their discipline of selling 4% out of money weekly calls, it would have destroyed 75% of your shares over that 10-year period. So in 2023, the performance of TSLY was up 50.55% versus TSLA. Just the stock itself up 101.24%. So if you exchange your Tesla shares, you sold your Tesla shares in your IRA or your Roth to generate more income, and you can generate income however you want. You don't need a magic ETF to create dividends. Your performance would have been much worse. And the way you can calculate how many shares that you would have gained or lost by being in TSLY is you take the percentage return, you add it to 1, and then you divide by the percentage return added to 1 of the stock itself. So you have alternatives with investing, and we're comparing alternatives. So when you divide the two, basically you get something like 0.7481, which means that you lost by having your money in TSLY 25.19% of your shares in 1 year alone versus just hodling the shares. Now, we're not totally opposed to covered calls. This ETF practices the most aggressive form of selling covered calls so they can claim they have maximum yield. It's some pretty degenerate stuff, in my opinion. Let's look at 2024, see how they did in 2024. So this is through Tuesday before Christmas. TSLY had a pretty good year compared to the market and everything. It was up 44.31% year to date. Tesla itself was up 86.04%. And when you do the math and you divide the performance of TSLY by the performance of TSLA, you find, if I could do the math backwards here, you find that essentially it destroyed an extra 22.43% of your shares versus owning the stock outright. This, I believe, isn't a good practice. They don't show the back test of their strategy on their website. And I believe the reason they don't do that is because it's not a winning strategy. I shared a video about this in August of 2023, and it shared some early results from 2023 through April. But what I'm showing you today is the full results. We believe if you're going to be a long-term Tesla holder, you should only add tactics and strategies that are potentially additive to shares, not subtractive of shares. We are coming out strongly against TSLY. It has destroyed shares historically. The only reason they unveiled this ultra aggressive strategy is it would have added to shares in 2022. I believe it would have added something like 22% to your shares. I could be a little off on that, but when you take it over time and take all the years, it would have been a destroyer of your shares. The reason why they launched it then, I believe, was a tad bit predatory because it was a extremely painful year for Tesla shareholders in 2022. At one point during the year, the shares were down 75%. It looked good for that 1 year, but they only launched toward the end of the year, so they didn't give the full benefit to ETF shareholders and have since destroyed shares versus buy and hold. This is not the tactic and strategy that we use for rebellionaires. These are people who have 2,500 shares or more in Tesla. We do cover calls, but we're much less aggressive. We use a much bigger margin of safety so that our shares are not threatened to be called away in a typical week, and in fact, most weeks, a vast majority of weeks, I should say. And we believe we're following tactics and strategy to be additive to shares over time. This is based off of the due diligence we did looking at actual Tesla stock options performance and prices historically. Now, past performance is no guarantee of future returns. And just because the strategy has worked in the past, it doesn't mean it'll work in the future. But one thing that might surprise you, if you followed a margin of safety in 2020, even when the stock was up 730%, it could have been additive to buy and hold. That really shocked Matt and me because we would think any strategy for cover calls in 2020 would have been a loser. So that's it for now. I'm Bradford Ferguson. Check us out on rebellionaire.com if you're interested in cover calls, adding trimming, and adding to your hodling to try and take advantage of the emotional highs and lows in the stock, adding some other growth companies to your portfolio on a very selective and small sliver basis, and also putting together a financial master plan to help you weather the downs and ups in Tesla share price. That's it for me. Bye for now.